In 2016, one of America's most trusted banks was exposed in a scandal that shocked the financial world, not for risky trades or market manipulation, but for opening millions of fake accounts in its customers' names. This is the story of Wells Fargo's fake accounts scandal, a case that would reveal how corporate culture, incentives, and greed can warp an entire institution. Wells Fargo, founded in 1852 and once considered one of America's most stable banks, built a reputation on trust. But beneath the surface, a pressure-filled sales machine was quietly driving employees to break the law. Employees were given aggressive sales targets known internally as 8 is great, meaning every customer should hold 8 products from the bank. In practice, these unrealistic goals led employees to create accounts without customer consent. Between 2002 and 2016, workers opened millions of unauthorized deposit accounts, credit cards, loans, and online banking services in customers' names, often without their knowledge. In September 2016, regulators finally revealed the scope of the abuse. The Consumer Financial Protection Bureau Office of the Comptroller of the Currency and the City of Los Angeles fined Wells Fargo $185 million for creating over 1.5 million unauthorized deposit accounts and more than spent 500,000 credit card accounts in customers' names. But investigations showed the problem ran even deeper. Estimates later revealed the true scale, as many as 3.5 million fake accounts and counting. Customers began noticing unexpected fees, statements for accounts they never opened, and damaged credit scores. Employees even resorted to forged signatures, fake email registrations, and fabricated identities just to hit sales targets. Former employees later told reporters that fake accounts began years before 2011. Long before regulators took notice and that the culture was top-down. One teller said managers regularly pushed staff to meet impossible numbers, essentially encouraging unethical behavior. The bank's internal structure, driven by cross-selling incentives and performance bonuses, created a system where results mattered more than ethics. Hundreds of employees were fired when the scandal broke, but many contended that the blame should have fallen on management. The scandal didn't just cost the bank in reputation, it cost them billions. Top executives were also held accountable. In 2020, Wells Fargo agreed to pay $3 billion to resolve criminal and civil investigations with the Department of Justice and Securities and Exchange Commission, admitting they pressured employees to meet unrealistic sales goals that led to widespread unauthorized accounts. Former community bank leader Carrie Tolstedt pled guilty in 2023 to obstructing bank examinations related to the scandal, a rare criminal acknowledgement in corporate banking fraud. In 2018, the Federal Reserve took an unprecedented step. It capped Wells Fargo's total assets at just under $2 trillion, preventing the bank from growing until it repaired its culture, risk systems, and compliance practices. Almost a decade later, in 2025, regulators lifted the asset cap, a sign that Wells Fargo had made substantial progress in addressing its issues. This scandal did more than cost money. It shook public trust in financial institutions. It showed how incentive structures, weak oversight, and a single corporate culture can undermine customer rights at scale. The fake accounts scandal became a lesson in ethics, regulation, and accountability, and a warning that profit without integrity leads to collapse. Wells Fargo's fake accounts scandal stands as one of the most notorious examples of corporate misconduct in modern banking. Millions of accounts, billions in fines, decades of consequences, and a lasting reminder: financial systems don't fail from markets, they fail from within. If you found this documentary insightful, hit subscribe for more deep dives into the scandals that reshaped global finance. Like, comment, and share, and don't miss our next story.